Welcome to Financial Strategies with Andrew Adjemi in Connecticut and Daniel Adjemi in Colorado.
AAA, it's a crazy world out there. Sally is out looking for a job in this crazy world, and Sally is a highly qualified candidate. She goes and she interviews with XYZ Tech Company. And XYZ Tech Company tells her that they will pay her $30,000 a year. And she has the potential, if everything goes right, and if the company does well, she can make $135,000 a year. It sounds a little difficult because it'd be pretty hard to live off $30,000 today. But Sally has another interview when she goes to www.flooring.com. And she gets in there and she starts talking to the owners, and she likes them a lot. And they tell her that they will give her $90,000 a year. And she has the potential to make $120,000 annually.
Whoa.
If things go right. I'm Daniel Adjemi.
And I'm Andrew Adjemi, and you're listening to Financial Strategies with Andrew and Daniel Adjemi, because people don't know what people don't know. Today's topic is retirees' best kept secret. And what could that be? It's a secret. Don't tell anybody. Well, that's where we're going with this today, and glad that you've joined us, and we've got a great show planned. Daniel, I'm excited to get into that. So, you know, those two things, right? When you're saying about Sally's two opportunities, and that's when I'm hiring people, I would love to have an employee come to work for me that will take $30,000 a year. And when we do well, that they'll be able to make all that money. But I can't find anybody like that. And the reason is because they can't, like you said, it's how are you going to live on $30,000 a year, right?
Right.
Well,
I mean, the listening audience, if you were Sally, which job are you going to take? The one that pays 30 with a potential to make 135? If everything goes right, or the one that pays 90 and you can make 120 if everything goes right. I mean, I can't imagine there's anybody out there that's saying they're going to take 30.
Right. Well, and so how does this relate to retirement? Well, when you retire, it's not that you need $1.5 million, $5 million to live. You're not going to go spend that money. What you need is a paycheck to replace the paycheck that you're getting. So now you go from your employer, receiving a paycheck from your employer, to getting a paycheck from your portfolio if your retirement portfolio is put together properly. And that's what we're talking about. So when we're talking about which would you rather have, $30,000 coming from your $1.5 million a year that you can depend upon every year, or would you rather have $90,000 coming from your retirement portfolio that you can depend upon every year and still have room for growth? Well, the decision is yours, but this is retirees' best kept secret, because most retirees, most people don't understand how this works. And today we're going to talk about that, with how that works. And the key is income. Okay. Definite. Right? I have a
Triple A.
I'm excited, Daniel. I'm excited here.
I get this question all the time. So everybody would choose 90. So why is this the best kept secret? Why do most financial professionals not automatically go for the 90 off of the $1.5 million? Almost every retirement and investment professional and retail investors, I think retail investors tend to be a little bit smarter, actually. Why do they all go for the 30 instead of the 90?
Well, there's several things that come to my mind. One of the biggest reasons is because that's the propaganda that Wall Street puts out. And Wall Street makes money on your money no matter what. So their goal is to have as much of your money in the market as long as possible. But that's not necessarily, they make money, market goes up, down, or sideways, but you only make it if it goes up. That's the first thing that comes to my mind, Daniel. And I'm thinking you have something else in mind.
Well, I don't know the answer to it. I think that income has become a lost art, for one thing, because we've been in low interest rate environments for another. A lot of people are younger in the industry and they don't appreciate dividends. It used to be a company paid dividends and they were proud of dividends.
Yeah.
And now it's share buybacks because it's the way corporate America compensates their executives is through stock buybacks, and they need their share price to go up. It's funny, you see more and more the businesses are not in business to do whatever their service is, right? What's an entrepreneur's job? An entrepreneur's job is to find a need and solve that need, and they get compensated for that, right? Look at Amazon. We wanted stuff delivered to our house faster. Jeff Bezos came up with this thing, and now you can push a button and whatever you want shows up at your house a few days later. He got compensated huge for that. He worked hard for that. He deserved that, right?
Right.
But now you have a lot of companies that are not interested in their product. You see it with hospitals are designed to take care of patients. But what's happening is private equity is coming in and buying up these hospitals, for example, and they're trying to squeeze out every bit of efficiency so that the profits go up and not so much worried about the care that the patients are getting coming in. I'm not saying the doctors are doing it. I'm saying the owners of the hospitals are doing it as they're getting bought up by private equity, for an example, right?
Right.
And when you lose that, you lose some of the incentives to pay dividends, things like that, to the shareholders. And maybe that's part of the reason why people think it's not possible to get that $90,000 because they don't know how.
Yeah. And well, it's an education thing. I believe in education. I just don't believe in the traditional forms of education because of, generally speaking, there can be a lot of propaganda in it and a lot of agendas that are being pushed. And Daniel, you're a very smart guy, and you've been homeschooled and went off and did your own study. And I'd put you up as your father against many people with their MBAs and even some with doctorates that if there were a way to show the two and think that you'd come in right in there with them, if not outshine them. And obviously, I'm very proud of you, very proud of your siblings from that standpoint. We believe in education, but that's why we homeschooled, because we wanted to do things differently. So in the same way, you're not going to get necessarily the right information from the normal outlets that are out there, whether they're educational, media, or whatever. You need to be able to have others. So you're listening to Financial Strategies with Andrew and Daniel Adjemi. Today's topic is retirees' best kept secret. And I'm excited about this show today. And we've got, this is already flying by. We've got a paper that we'd love to give you to go along with today's show on the retiree's best kept secret, and this is called Passive Income for Retirement. There's a lot of people out there talking about passive income, and when people think about passive income, a lot of them think about rental income, right? Real estate rental income is passive income. And I talked to somebody recently that have been investing for quite some time in real estate. The real estate's gone up in value, and they're getting minuscule passive income, if any, ultimately, because they're doing so much work for their money. I don't call that passive income. It's just their paycheck that's being paid by the rental income. This is talking about true passive income. That's what today's show is, the best kept secret, true passive income for retirement. We'd love to put this paper in your hand. It's only about 3-4 pages long, this easy read, and we'd love to give it to you for free. Call us at 800-725-7616, 800-725-7616 for your free copy. Ask for it by name, Passive Income. You listen to Financial Strategies because people don't know what people don't know. And we want to educate you so you can make smart decisions. Daniel, this is an exciting topic as we talk about this. And this whole thing about income and the retiree's best kept secret, right? One of the first secrets is that retirees don't understand necessarily the concept that they need income. And they think, I need $2 million and $5 million or whatever it is. No, because you're not going to go spend that money. You need income. And then I hear, so how many times do we hear, oh, I'm going to withdraw from that money. I'm only going to live 10 more years. How many times have I heard this? I can't, believe it or not, folks, I've heard this. I'm going to live 10 more years. I said, what happens if you live 15? Oh, it's not going to happen. But what happens if you live 15 and you're planned for 10 and you have $1 million, you're going to take out $100,000 every year out of that. And what happens if you live 15 years instead of 10, right? And that's problematic. But we're not, that's not today's show. But you know, they think in these terms of withdrawing $100,000 every year from their million. And that's ridiculous. That's engineering income. You need income, and that's a way to get it, but it's a ridiculous way. It's old-fashioned. It's not even old-fashioned. It's probably more new-fashioned than it is old-fashioned. Because the old-fashioned way, like you said earlier, Daniel, fixed income has gone the way of the dodo bird, right? The way of the dinosaur. Because the people, 50s, 60s, 70s, people knew about this kind of investing. And that's what they did. But then when the 80s and the 90s and the stock market increasing 1,000 times, so many times, multiple times, 10, 20 times, people forgot about this. And the people that knew how to do that stuff died. And so this is where we're bringing back old school. So there's no school like old school when it comes to retirement. And so you can do old school retirement and get passive income from your investments that are working for you. Or you can withdraw money, do engineering by withdrawing money, which works great if your money's invested in growth-oriented stocks in like the, let's see, what was it? It was the XYZ tech company. And as long as the company's doing well and you can make $135,000 a year, that's all well and good. But what happens about those years that the company goes sideways or the company actually loses money and you're making 30 grand a year? What does that do for you? That doesn't do anything. Right? Whereas if you're working with the www.flooring.com and you're getting 90 grand a year no matter what, and you have a good year, hey, that's just icing on the cake versus not having enough money. And so what I want to say is that the definition of perfect retirement is having more than enough income to live the rest of your life, more income than you need to live the rest of your life in the way you want to live the rest of your life. You're listening to Financial Strategies. Thank you, Daniel Adjemi. Before we take a break, I want to tell you about, we got a book that we want to give you called More Life Than Money by our friend Anthony Siccaro. Anthony's done a masterful job of writing this simple, easy to read book that talks about those things that you don't know, what you need to know about retirement that you probably don't know. And we love to put this in your hand for free so that you can be educated and make smart decisions. Call us at 800-725-7616. First 5 first-time callers, 800-725-7616 for your free copy of More Money Than Life by Anthony Siccaro. Call now.
The biggest mistake retirees make is not switching from the growth model to the income model. You know, a good retirement plan is having enough income to last the rest of your life. Any problem in retirement, it can be solved with income. The biggest concern that retirees have is running out of money. The second biggest concern is that they want to grow their money so that they don't run out of money. And they think it's synonymous when it's not necessarily the case. People don't know what they don't know. And they're not going to know unless somebody tells them. People think that the only thing that they can do to grow their money is by investing for growth in the stock market. And it's very much a herd mentality. But you can only get growth when the market goes up. When they invest for income, they're able to get money no matter what happens. I'm Andrew Adjemi, founder and CEO of Adjemi Financial Strategies. We've been helping people enjoy stress-free retirement for over 30 years.
You're locked on to Financial Strategy with Andrew and Daniel Adjemi.
So if I were to say to you, Daniel and I, we run an average of 10 miles a week each. You might say, wow, that's pretty good. And at one time, if you looked at me, you say, Andrew, but you don't look like a runner. And I would say, well, actually, I'm not. And actually, Daniel runs 20 miles a week, and I sit on the couch and watch him. I'm Andrew Adjemi.
And I'm Daniel Adjemi. And you're listening to Financial Strategies. Today we're talking about retirees' best kept secret. And maybe it's the best kept secret from retirees, but AAA, well, tell us about running.
Yeah, well, I will in a minute. But, in regard to that, right, we got a lot of retirees that like this stuff, right? Yeah. And that's why we say it, because you know what? They like this stuff. And when the market dropped in 2008 and that kind of thing, they liked it so much, they kept it quiet. They wouldn't tell their friends that we could help them. They were afraid. They were embarrassed to tell their friends that they didn't lose any money. Their friends were saying, "Oh, I lost money like everybody else." And our clients were like, "I'm not telling them I'm not telling them I didn't lose any money." Right. And so it's kind of frustrating from our side because we want to help more people, but nevertheless. So the averages, the point of that story was averages fool us. We can't talk in percentages. We can't talk in averages. You know what they say, right? Figures don't lie, but liars figure. So when you talk in averages and you talk in percentages, it's very similar, right? When I first got in this business, Daniel, right, 35 years ago, there was this guy that I talked to, and a piece of wisdom I got from him was, he said, "Andrew, you can't spend percentages. You can spend dollars. Talk in dollars, not percentages," right? And I have obviously remembered that for 35 years, and I've used that, right? So that's the point. That's the point of the story, right? On average, Daniel and I run 10 miles a week each, right? But the rest of the story is I don't run it on, he runs 20, right? But so when it comes to people's retirement, when it comes to the average that people are getting on their retirement portfolios, right? Daniel, I saw somebody's thing yesterday, somebody's portfolio. It said they got it. Are you ready for this? It says year to date this year, right? 22% return year to date. And there was no way this portfolio did 22% year to date. I mean, granted, the money went in, most of the money went in April 11th when the market was already down, but the market hasn't come back 22% since April 11th, right? And so it's like, how in the world are they figuring? You talk about liars figure, right? This is a statement from the investment company, says 22%. And you can't, I'm a financial professional, been doing this 35 years, and there is no way I could figure out how in the world did they come up with 20. I've never been stumped like that on it. Usually I can figure it out, but right? It's just crazy. So my point is you have to understand in the dollars, in the cents, and that kind of thing, right? So that's where we come in and we talk about the stock market, right? And TR equals I plus G, right? We talked about that before. Total return equals I plus G, income, interest plus growth. The problem with growth is it could turn into a loss, right? Growth is $10 a share, $11 a share, $12 a share. It doesn't compound. It's just a growth of the share price. But it can also go the other direction from 12, 11, 10, 9, 8, 7 kind of thing. And that's problematic. And that gives you the total return. And so this is a way we segment this down and we give the rest of the story when we're talking about returns. So Daniel, this is your bailiwick, talking about the stock market over 150 years and what the average is and that kind of thing. And you want to pick it up there because I'm talking too much.
Yeah, well, those numbers we came up with Sally's job interviews. Do you want to collect the $90,000 a year and potential to make 120? Or do you want the 30 and potential to make 135? It's basically, if we look at TR equals I plus G, like you just said, total return is made up of income plus growth. Now, almost all investment people go for growth plus income. And so if we look at S&P returns, we can come up with the S&P does about 7% annualized in growth and about 2% in dividends. So the 2% on a $1.5 million portfolio is $30,000 a year. That's how much you can count on. Right?
Right.
And then the 7, it might be minus 27 one year, it might be plus 30 one year. Probably not going to be 7. It's probably not ever going to be 7, but it will average out to about 7. Right?
Right.
And that's where we come up with those numbers. And the 135 being 9% off of your money. But it's not going to be 9% a year. It's going to be minus 20% one year. It's going to be plus 28% one year. It's going to be 0 one year. It's going to be plus 10 one year, right?
Right.
And so That's a difficult way to live off of, even if you have that $30,000 of dividends, which is what we're saying is about 2%.
Right.
On the other side, when we talk about TR, total return is made up of income plus growth, we're going for that 6% in dividends. And that's where the $90,000 comes from. You are getting paid that. And we show clients that all the time because we run these reports where it shows their projected monthly income in dividends, not growth, not hope, dividends, what these investments are going to pay them. And then as the month goes through, or as the year goes through, we show them what was projected and what they earned. And now they can say, I made X in January, February, March, April, and they can check that. And it's just a cool thing. It's a different way. It's a secret.
That's right. That's
that
right.
nobody talks about, where you can actually project what you're going to earn and then you see what you earned instead of hoping that we have a good. We hear it all the time. People use it in their late. You were telling me earlier about something completely different. AAA. You listen to the way people talk to see their paradigms. And we hear it all the time. We hope the market does good. We hope we can do retirement. We want to take the hope out of retirement.
That's a good slogan. Let's take that. Let's do that, man. That's great. You're listening to Financial Strategies with Andrew and Daniel Adjemi. Today's topic is the retiree's best kept secret. And most retirees don't know about this. A lot of people don't know about this. Unfortunately, professional financial people don't get this either, based upon what Daniel just said, because they're going for growth primarily. But nevertheless, it's a way to be able to have more than enough income that you need to be able to last the rest of your life. And we'd like to give you a paper that goes along with today's show. And actually, I'm going to mix this up a little bit, and we're going to give away the paper, TR equals I plus G. Formula for a more successful retirement. We'd love to put this paper in your hand. We were just talking about it. We're going to talk about it some more in a moment, but this 3-4 page paper will give you some good information, education, so you can make smart choices and understand the best kept secret of stress-free retirement, retirees. And we love to put this in your hand for free by calling us at 800-725-7616, 800-725-7616. Yours for free, 800-725-7616. TR equals I plus G. Call now. You listen to Financial Strategies with Andrew and Daniel Adjemi, because people don't know what people don't know. Today's topic is retiree's best secret. Daniel, as we're talking about this averages and the TR equals I plus G, that was great how you said most professional financial people are going for the G. Secondarily, the I. Right? And if you want your retirement to be stress-free, invest for the I first and then the G. And that's what you were just saying, right? Where the $90,000 a salary would be getting is the 6% I, and then the icing on the cake is the 30% more that would come in because things go well. Let's talk about that.
The 2%, which is $30,000. Yeah. So it's complete opposite, right? The 6% you get paid, that's dividends and interest. That can be a direct contract, that can be indirect contract, meaning you have a contract that says you're going to get paid that, or the investment vehicle that you own has a contract that says you're going to get paid that. And that's all based on the individual, how much they want in those buckets. But there's a contract connected somehow that says you're going to get that. And that's why we can say with that 6%, you're going to get that percent, because it's not a hope, it's a contract, right? And then the 2% is the growth that we'd like to get on top of that. Yeah. And there's a lot of different ways that could come up, but it's backwards. It's backwards from what usually happens, where you go for the 7% first and the 2% second. And some people may have noticed that one is 9% and one is 8%. And so maybe that is why people go the other way around for that 1% difference. Or maybe it's because interest rates haven't been at this number, but we're kind of sandbagging the income numbers because we don't know rates are going to stay as high as they are right now. If you did it now, if you made that switch from the growth to the income, you'd probably do a little bit better than these numbers that we're saying. But we're using averages. We're using long-term averages to get these numbers. But that's that goal where you switch from the hope of the 7% to I'm going to get paid 6% and giving up that 1%. And these are hypothetical, you might still do better, but giving that up for these so that you have that certainty and you don't have to sell at a 30% loss, or you don't have to stomach a 60% drawdown and sell out at the bottom. You're eliminating a lot of these things that destroy retirees and investors by switching models, because it gives you the more robust portfolio, more stable portfolio.
Right, right. And our time is just like fleeting by, Daniel. And I can't believe that we're halfway through the show already. And we haven't even finished the first point, So this is like crazy, right? We're having a good time. Hope you guys in our listening audience are. You listening to Financial Strategies with Andrew Daniel Adjemi. Today's topic is retirees' best kept secret. And it's the best kept secret because many retirees don't know about this. Number one, and those retirees that do know about it, they typically don't tell anybody about it because they like it so much that they think it's too good to be true. They want others getting in on that. And we want to tell you more about how to get in on it. And with that, we have a book to be able to help you understand how to make smart decisions when it comes to your retirement by knowing what you don't know. And that's why you want to get educated, right? That's why we hand out books, because we believe in education. We educate thousands of people a year between our radio shows, our webinars, our seminars, and all the different things that we do. And so this book, More Life Than Money, by our friend Anthony Saccaro, CHFC Esquire, is here that we'd love to give you, because Anthony's done a great job of writing this book. Simple to read. Each chapter talks about another piece of retirement that you don't know that you don't know. And you're going to learn something from this book, and we want to put it in your hand. And if you have any questions, glad to answer those. Or if you just have other questions in general, please let us know. Call us at 800-725-7616. Let us know what's on your mind. If you want this book, if you're one of the first 5 first-time callers, 800-725-7616. Let's try it again, 800-725-7616. You can have a free copy of this book that Anthony wrote, and we'd love to put it in your hand. And we look forward to talking to you more. Come back after break. Retirees' best kept secret for you. We'll be right back. Hang on.
This is Financial Strategies with Andrew and Daniel Adjemi.
AAA, I was on the call with one of our clients the other day, and we were talking about this exact thing, TR equals I plus G. Talk about it all the time, and how we're the opposite of the typical investment strategy where we go for income first and growth second. And Joe asked me on the phone, where does that 2% come from? I get the 6%. I've seen it coming into my account. I look at my statements and I just see dividend, there's just this whole long thing of all this money coming into the account. She's like, I get the 6%, but where's the 2% come from? And I said, you see on your statements, you see there's a lot of trading going on in the accounts. I said, the way that these portfolios are designed is this passive income. You could just sit back and collect all those dividends. But what we like to do is we like to add some value to you, or what the industry calls alpha. And we know when things are high and we know when things are low in the fixed income, and we know when things are the wrong price. And so we like to buy those, sell out, and get into it. And that's where 2% can come from, is by skill of the manager. I'm Daniel Adjemi.
And I'm Andrew Atchme. You listen to Financial Strategies with Daniel Atchme. Today's topic is retirees' best kept secret. And retirees' greatest fear is running out of money before they run out of life. And that's the secret, because you don't have to do it that way. You can have more money than life. My idea of the perfect retirement is more income than you need to live the way that you want for the rest of your life. And that's what we're talking about today. That's the best kept secret, that you can indeed have that. But you're not going to hear this from most people. So Daniel, that's great story that you had there and situation that you're telling us there. The whole thing about business investing is buy low, sell high, right? I mean, think about it. Walmart does it. Gas stations do it. Restaurants do it. They buy stuff cheap. They sell it for more. That's the whole thing about investing. If you can buy low and sell high. And the key is knowing when is low and when is high. And when it comes to the things that we're investing in this world of bond and bond-like instruments, we know what is low and what is high. And when we trade in and out of those things, Daniel, I see new clients come in and they say, man, I got a bunch of trade confirmations for this thing. And I say, yeah, that's because we're doing a lot of trading. Why do I have 70 different things that your positions on my account? I said, well, the Dow Jones Industrial Average is 30 stocks, positions in there, because less than 30, you don't get good, true diversification. And we're going to talk about this in a bit. And then the S&P 500 is 500 because more than 500 doesn't really do you any good. So somewhere in between 30 and 500 does. And so we put you at 70. And some of those things are like minuscule positions, and some of them are bigger positions, depending what it is. But they're doing different things. And that's where we're going to talk about, folks, in a moment, about true diversification. But this thing is buy low, sell high, and that's what we're doing. It's difficult to do that with the stock market. But Daniel, tell us about how we do that when we trade and when we manage people's money.
Well, that's why that's one of the reasons we're such big proponents of corporate credit, for example, right? Or contracts, investing by contract, because we know what we're going to earn. So if you go by Bitcoin or you go by Apple stock, what's high and what's low, right? People have been thinking Apple stock is high for a long time and it just keeps going up. Are their earnings going up? No. What's happening is people are putting a bigger PE, price per earning. They're getting more value. So you don't know if it's expensive or it's cheap. What's a good PE? Is 8 a good PE? Well, if it was 8, you'd probably think that's a good PE to buy. But if it's trading at 40, is that a good PE or is it bad? Is it going to go to 50 PE? Nobody knows. I tend to think it's going to go lower, but somebody else thinks it's the best company ever and it's going to go to 50. So that's what happens when you're investing for growth first. You don't necessarily know. Well, when you have a contract, you can have built-in growth. So if you buy a corporate bond, for example, under par, right, and you buy 10 bonds and you pay $9,000, you're going to get paid $10,000 when that company buys those bonds back for you. So you're going to earn your normal interest and you're going to earn 10% contractually over that period of time. Right?
Nice.
So that's one way we can do it. Another is there's a lot of things that people don't understand. There's not the same amount of investors in the fixed income markets as there is, especially in corporate fixed income markets, as there is in the stock market. And
that's why the retirees just want to keep it a secret, because they don't want more joining. But go ahead.
Right, exactly. And so there's things that are priced better. There's things that are priced too expensive, and there's things that are priced cheap. And if you understand that, you can take advantage of that. You can sell the things that are too expensive and you can buy the things that are cheap. And there's a lot of this that goes on in these fixed income markets. So when you pay attention to this every day, for example,
treasure hunting, right, Daniel?
Treasure hunting, right? We find stuff on sale. We find stuff with the wrong price tag, and we buy that up, or we sell it, depending which way the direction it is, if it's too high or too low. So a company wants to issue some preferred stocks. So they go out and they find a investment banker to sell their preferred stocks. And the investment banker has got to hold those on the balance sheet until they sell. So what do? They price them too high. So they say they could probably sell this for a 6% coupon. We're going to do a 7% coupon and make sure they sell and we get our money. So they offer these 7% coupon preferreds when the typical creditworthiness of a company would be trading at 6%. We get the option to buy those at par. So we buy those at par. So we buy them at $25 a share to get our 7% coupon. As soon as they go on the market, they go up $1, $2 a share. $1 or $2 a share at 25% par is what? 4 or 8%, depending on those, right? Sure. So we just got built in because we understand what's going on. 4 or 8% on top of our
7%
coupon, right? The income that we're going to collect.
Right. And that's a beautiful thing, right? That we sell that stuff and then it comes back down because we know when it comes back down, we rebuy it lower and we walk away with the profit. Beautiful thing. You listen to Financial Strategies with Andrew and Daniel Adjemi because people don't know what people don't know. And today we're talking about that thing that people don't know, retirees. Best kept secret. If you're one of our clients and this is what we're doing for you, and I know that you don't want to tell people, and I get it, right? But we want to tell more people because we want to help more retirees that don't know this stuff. So, and with that, we got this paper that we'd like to give you today called TR equals I plus G, the formula for most successful retirement. What's the most successful retirement? Well, my definition that I'm using today is that perfect retirement is more than enough income to do whatever you want to do during retirement and to be able to live the rest of your life without running out of income, without running out of money. So that's a beautiful thing. And so we'd like to give this paper for free. Call it TR equals I plus G. Ask for it by name. TR, total return, equals I, income and growth, or income and interest, plus G, growth. TR equals I plus G. Ask for it by name, 800-725-7616. Call now. Daniel, as we continue to go on with retirees' best kept secret, right? Trading that we do, buying low, selling high, it works real well. I tell people that the only time we're trading is to either put you in a better position or to protect your money, help you make money or protect your money. And we don't make money when we trade. It actually costs us more because we're working harder. So, but that's what we contract with our clients as true fiduciaries to do, is to work hard to make them much money. And that's why we got a 4.9 Google review, because our clients are so happy with us and what we're doing. And that's we're looking for their happiness and for making our clients happy. But, with this, when what you just spoke about, Daniel, and we are on average picking up a 1 or 2%, sometimes more. Like what you just said was we pick up, depending how long we own that position, 4 or 8%. If we owned it a year, right, maybe we're making 4% or something, 1 or 2%. But then that compounds. That's compounding is an amazing thing, isn't it, Daniel? Can we talk about this before we go?
Einstein said it. Compounding is the eighth wonder of the world, right? Those who understand it earn it, compounding interest, and those who don't pay it, right? And yeah, you're absolutely right. And before I let you get into what you were just going to say, we will have clients who will say things like, well, what's 1 or 2%? Like, you're doing these trades, you're getting me 1 or 2% more. So you got the 6%, right? What's 2% more? Like, so what? You got 4% on a preferred in 30 days. So what does that do for me? And it does a lot. It does a lot. And most people don't do that. You could go buy a preferred fund and it's going to have more volatility and it's going to have less returns. Why? Because that 2% adds up to something, right, AAA?
That's right. And Daniel, that's how I started this I think that's how I started the show today, right? Maybe it wasn't. Anyway, in the show, I talked about percentages fool us, right? So when people think in terms of percentages, 1 or 2%, they get fooled thinking, that's not very much. Well, let's put it in dollars, Daniel. We're talking about Sally, right, with the $90,000 from the one company or $30,000 from the other company. We're doing that based upon a $1.5 million portfolio. So that $1.5 million portfolio gets 1 or 2% or 2% every year compounded over 10 years is over $300,000, just that. Not including the coupon, not including the other growth, $300,000, $331,000 just from that 1 or 2% compounding over 10 years. So that is nothing to sneeze at, if you ask me, right? That is substantial.
It makes me sick to think about people who say, who cares about 1 or 2% when you say that? And for the fund managers who give up that 1 or 2% because nobody cares about it, right? And we say to our clients, we care about it and we want you to have it. And that's, like you just said, $331,000 that 2% makes up over 10 years compounding. We want our clients to have an extra $331,000, and we have the skill to get it for them, so we're going to get it for them. And if you're a client, you're listening to it, that's why we do that extra 2%. That's why we do that trading to get you that kind of money.
Right, exactly.
We care about you. If you don't want it, then give it to a good charity. Give it to a good cause.
Right. There you go. And not enough people doing that. Exactly. Retiree's Best Kept Secret is today's show title. And you listen to Financial Strategies with Andrew and Daniel Adjemi. And we've got a book before we go to break. We're having a good time here. Hope you are too. Called More Money Than Life by our friend Anthony Siccaro. This book is a phenomenal book. I highly recommend it. Easy to read. It's got a lot of good stuff telling you what you don't know that you don't even know about retirement. And I encourage people to use this as a primer. Gave it away to most of my clients, to all my clients that came to Client Appreciation the year that it was issued last year. And we're glad to offer it to you today. For the next 5 first-time callers at 800-725-7616, 800-725-7616 for your free copy of More Life Than Money. Call now.
Do you have any questions for me about retirement income source?
I just want to make sure I can invest well enough to have enough income, enjoy my retirement.
We build a custom retirement plan based around your income and goals.
How do I know I can trust you?
Building trust does take time, but our investment advisory arm is comprised of fiduciaries, which means our obligation is to you. So you can enjoy your retirement. It's a little more income stability.
I'm in.
That's 2 out of 3.
You're locked on to Financial Strategies with Andrew and Daniel Adjemi.
So the first time I read the Bible all the way through was, I believe, 1976. Actually, no, I'm sorry. I think it was 1977. I was a senior in high school, and reading that through and recognizing how people, when they built the temple and they built the tabernacles in the Old Testament, God gave these guys these craftsmen talents with gold and with silver and with other things in the temple to be able to make this temple very ornate and very much part of their worship to God by building this in this right way. And I said, oh man, I am a man that likes good craftsmanship. I wish I had that ability. And as time went on, I thought, oh, that'd be so good. And then I realized, not so long ago, that's exactly what God has done for us in regard to the financial industry. He's given us that talent to be able to best that we can be for His glory, to be able to help people to have the best kept secret. I'm Andrew Adjemi.
And I'm Daniel Adjemi, and you're listening to Financial Strategies. Today we're talking about retirees' best kept secret. And AAA, it's a wonderful thing to be able to use those talents to help retirees because a lot of people are afraid of running out of money. And when you used an example earlier, when you think of it, which is the way we are taught to think about things, I've got $1 million, so I can spend $100,000 a year for 10 years, and then I'm out of money. And that's the way we have been programmed to think about these types of things. Or I hope that I earn 10% a year, so that means I can draw $100,000 a year off of that, and I won't touch my $1 million. The difficulties come in. Neither of those assumptions are proper.
Right.
It's not long enough for 10 years just to draw off the money. And because of the way sequence of returns, the way the returns come into the account, markets aren't consistent 9%. You can run out of money even though you might say markets do 9 or 10%. It's the sequence or when you start taking that money that it actually matters.
Right. And that's where people do financial planning. And I really don't like financial planning. They use Monte Carlo analysis and other analysis. And in my mind, it's either fact based upon fiction or fiction based upon fact. And that's why I like strategies better than planning. Because you put together a strategy that's a good strategy, a good, sound, long-lasting strategy that's been used in generations before, and you just tweak the strategy. And that's why our company's called Adjmi Financial Strategies, because it's about the strategy. That's why the show is Financial Strategies. It's about the strategy. It's not called financial investments. It's not any of that stuff. It's about strategies that include estate planning strategies, investment strategies, tax strategies, all kinds, life strategies for life, right?
Right.
And so all these
and it
different
changes.
things, and it changes
depending on the environment. Right. It changes depending on the environment. That's why the strategy is so important.
That's right. That's where you have a plan and you have to go from plan A to plan B to plan C. But you know what? You can run out of plans. There's only 26 alphabets, 26 letters in the alphabet, right? You can run out, right? So the strategies, there's one strategy, and it's the tweaking of the strategy. So that's what's so cool. But anyway, my point, the whole point that I'm trying to say is that the best kept secret of retirees is having more than enough money to live the rest of their life in all the ways that they want to do. And you do that through investing for the I rather than the G. We do that by trading, by picking up 1 or 2% compounded over time, timing things because we know when to buy, when that's high and when is low, so we can buy low, sell high, all these kinds of things. But then there's also true diversification so that we can have less volatility and more stable accounts. And what retiree would not want? Less volatility and more stable accounts. Well, those retirees that are so gung-ho on growth and being able to go to their neighbor and say, hey, look, my account is up. I made 20% this year. Look, right? Those people, right? Those people that get off on the adrenaline of seeing their accounts go up, not those people that are thinking logically and methodically, strategically toward their retirement. But that's where true diversification comes in. That is huge. When we add true diversification, you get things happening like where the stock market, the S&P was down 15% recently, and our portfolios were maybe down 4%. That's a whole lot less volatility than the S&P 500. And then when you combine that with the 6% give or take dividend coming in, woo! You know, that equals more stability, less volatility, and more peace for the retiree. So is that part of the best kept secret of retirees? You bet it is. So let's talk about this diversification for a minute. And, we're running out of time real fast, Daniel. Okay, I'm sorry. I'm talking so much that I'm sorry time that I got to tell you, you listen to Financial Strategies, Daniel Adjmi, and today's topic is retirees' best kept secret. And if you can't tell, I'm having a great time. I think Daniel is too. He's smiling a lot, those that can't see him on YouTube. But the point being here is that retirees' best kept secret, having more than enough money to be able to live the rest of your life without having to worry about anything. More than enough income to live the rest of your life, not money. And we have a paper that we'd love to give you. It's called Passive Income. A lot of people will go into real estate to get passive income, or they'll do multi-level marketing to do passive income, or they'll do these other things to get passive income. It's not really passive. You have to work stinking hard to get to the point to where it is passive, if it ever is truly passive. We have a lot of retirees that talk to us about selling their properties because they're tired of managing their properties. They're tired of doing the work on their properties. They're tired of only netting maybe 2, 3, 4% at best after all expenses on their real estate portfolios to be able to come up with a 6% net after everything on a passive income portfolio for their retirement. And so this paper we'd love to put in your hand is called Passive Income. It's yours for free, 800-725-7616, 800-725-7616 for your free copy. Call now. So true diversification, we're running out of time. And then there's also wholesale versus retail, Daniel. So I would like you to talk because I've been talking an awful lot in this show. So,
well, the true diversification is something that I think is way overlooked. In today's day and age, the way you get diversification is you buy another ETF. Right. So I want some gold diversification. I want some emerging markets. I'm going to buy. And the problem is nobody really knows what's in those ETFs, how they're structured and things like that. They just buy the ETF. They get a hot tip from somebody and they buy the ETF. And some investment vehicles are not designed to be in an ETF. For example, if you buy corporate bonds, you can buy an ETF. And you can own corporate bonds in the ETF, but you give up the two guarantees that you buy bonds for. The coupon, so you know how much you're going to get paid, and the maturity, so you know when you're going to get paid back. And an example I would give is we recently took over the investment management for a big investment portfolio that had investment managers managing it. They didn't do a good enough job. And so now we're investing those assets. Right. One of the accounts that came over, it was in Connecticut municipal bonds. How could Connecticut municipal bonds go bad, right? But she had on a $500,000 account originally, it was down to $430,000. It wasn't because she took that money out. It was because the municipal bonds came down that much in value because they were bought at the wrong time. And somebody said, well, all she has to do is hold those to maturity and she's back. Well, if you buy them over par, you don't get back. And if they're in a bond fund, you don't get them back because they don't have a maturity. So she gave up the coupon and she didn't, the investment manager did this. She just trusted the investment manager. Right. And so now we're trying to unwind that for her and get her into what we're talking about, where you have a coupon and a coupon is what you will be paid, and you have a maturity when they will give you your money back. Right. And that's what you give up. So it doesn't have the reverse correlation. It doesn't have the stability that you're used to or that you should have, the old fashioned way of doing things. When you were buying assets, you knew what they were going to do. Right. Same with gold. The physical gold reacts a lot differently than if you have an ETF of gold. Everything gets overhyped, right? And it gets overdepressed in different market situations. And so when you're in funds, that happens even more so than the actual assets. And so when we're talking about diversification, we're trying to talk about the actual contracts associated with diversification, right? Or as much as you can do in an IRA.
Right.
And so ideally, you have something that's benefiting from chaos. So when markets are selling off, you have stuff that's going up. And as it gets too big of a percentage of the portfolio, you're selling that off and you're going into the things that were over depressed and sold off. For example, in this last market sell-off, fixed income, right? Preferred stocks and corporate bonds sold off more than they should have. Everybody just said, we don't know what's going on. And these things were not affected by tariffs. These were not affected by the sell-offs. These things were not overly expensive like S&P was. So they sold off. So we had cash sitting there, right? And we said, well, we're going to buy this stuff. And then a couple of days later, before S&P took off again, or it still hasn't recovered before it started making its rounds back, people realized, these yields are too good. This shouldn't have sold off, right? So that's what we're talking about with the diversification, where something's benefiting from chaos, something is sold off too much, it's too depressed, and you can move into those things and take advantage. And that's where you want to be with a uncorrelated, truly diversified portfolio. And when you tack income on top of that, you always have cash coming into the account that you can spend or reinvest. That's the ideal retiree's portfolio, if you ask us.
Nice, Daniel. That is beautiful. I love that. And that's why we need to keep you working on investments rather than managing the employees or the company or any of that kind of stuff. So, all right. But, going along with that is wholesale versus retail. Who would pay somebody to find them a mechanic to work on their car? But yet that's what many people are doing when it comes to their investments. And because we're managing this stuff, you come to us, it's wholesale. It's on sale, wholesale with AGME. And that is very key. You don't have to go with AGME, but just make sure you're going with a manager rather than just a middleman that's finding you a manager, because, that's not going to work. That doesn't work well for you. They're digging into your pocket, folks. So anyway, you've been listening to Financial Strategies with Andrew and Daniel Adjemi. Today's topic has been retirees' best kept secret. And to have more than enough money and income to be able to live the rest of your life and do the things you want to do is the best kept secret. And that's what people are able to do. People that are investing with Adjemi Financial Strategies are doing, and with other companies as well. It's far and few in between, folks. Most people out there most professional financial people have no clue how to do what we're talking about. So we're a needle in a haystack, and glad that you can come with us so we can educate you. If you have any questions, call us 800-725-7616. Hit us on the web, agemi.com, AGEMY.com. And in the meantime, we want to give you this book, More Money, More Life Than Money, How Not Outlive Your Savings. And we love to put that in your hand to the next 5 first-time callers at 800-725-7616, 800-725-7616 for your free copy. Hey, and until we get together next time, remember, a stress-free retiree invests more for the I rather than the G. Peace.